You just found your fifth investment property. You go to the bank that lends you for the first 4 properties and you take your income statement for the other 4 rental properties and your W-2. You wait a couple of days and after that you receive a call back from the bank. They have news. Your loan was rejected. But why? This is because the bank relies on all your income for this loan. That includes the 4 rental properties and your salary you receive on your W-2. So the bank doesn't want to take the risk on that maybe you lose 1 or 2 tenants, or maybe you lose your job. So they are out of the deal. But what if I tell you there's one type of loan that you can apply for the 5th investment property, and the bank will not ask you for all the other income you already have, but only for the income from this 5th property, the rental income. Yes, it is called DSCR loan. And in this video, I'm gonna teach you how you can get a loan with this type of loan. Follow me. Let's see the difference between these 2 kinds of loans, the home loan and the DSCR loan. Okay, so first of all, the income. As I told you, the income for the home loan the bank asks you for is usually the W-2. So that's your salary, your wages. They can also take your rental income for the other properties, and maybe if you work for your own, you have a real estate business, your commissions, some income they can take. And for the DSCR loan, the income they take is the property income. You don't have to have the property rented out already. They will just make a market research and they will take the market rent of the income. But if you already have the property rented out, that's better. That's better for the bank because they have more security on that. And you also can take some fees on the property. For example, you have a laundry inside the building, you can take that kind of income on the DSCR loan. For the down payment, it's a little bit better on the home loan because you have some federal programs that let you put up to 5% down payment on those kind of loans. But also you have to pay some kind of mortgage insurance or something like that to get this income reduced to 5%. Okay, for the DSCR loan, you have usually to put 20% or more of the total cost of the property. But there are many ways you can get this money. This is a topic for a new video, but maybe you can get a second loan from the seller, a second line, or maybe you can get investors or something like that. But it's a little bit more you have to put on down payment on the DSCR loans. Okay, for the monthly payment, usually the bank takes not less than 30% of the rents of your total income to approve your loan on this home loan. But for the monthly income, the bank usually takes the 30% or less of your total income. That includes your salary, your rentals, or the commissions. But as I told you, if you have many rental properties already, they may not take that income from this new property, because after 4 properties, the bank is taking too much risk. And for the 5th properties, they will not consider all the rental income. So it will probably reduce your chances to get the loan or to get the amount of capital you need, of money you need. Okay? So for the DSCR loan, it works different than for the home loan, because usually are some banks that lend for DSCR loans, but mostly are private lenders. So they ask for 1.2% of the DSCR. What means DSCR? It's debt service coverage ratio. So this 1.2% means you have to have 1.2 times the amount of monthly payment. That this number is the debt service coverage ratio. That 1.2% includes the rents, less the PITI. Okay, PITI means principal, interest, tax, insurance. So this works kind of different, like for the big multifamily or commercial property, because in big commercial property they ask you for the net operating income statement. So you have to, usually in the big commercial property, you have to stabilize the property. That means you have to rent it out for at least 1 year in order to get income statements, and the bank knows how much are your rents, how big are your vacancies, and how much are your expenses. But here in the DSCR loans, it's kind of a commercial loan in the way they lend you for commercial properties. It's easier because they only take the market rent. You don't have to have the property already rented out. And the type of loans for commercial loans that you see on the news, that maybe some big fund purchase a multifamily 300 units and he gets a commercial loan from a big bank, but these are for smaller properties. So for the big guys, they make a due diligence that lasts like 6 months or maybe more, and they ask for the income statements. But for the DSCR loans, it's kind of faster way to do that, because they consider the market rents and they know how much interest you will be paying, they know how much property taxes you will be paying, and they already know how much insurance you will be paying. So they can calculate all these numbers without doing a big due diligence like for a commercial property. So that's one of the advantages of the DSCR loans. So they are like a commercial loan, but for small commercial. This is the ideal to give the first steps into commercial if you already rent out some properties, like single family properties. As I already said, it's 1.2% of your rents less your principal, interest, tax, and insurance, and you get the monthly payment for the DSCR loan they will approve. For property types, the home loan, it only works for single family or 1 to 4 units, like a fourplex. That's because they have a secondary market, the banks have a secondary market, and they have housing agencies like Freddie Mac or Fannie Mae, and they only purchase 1 to 4 units, the mortgages. So they only lend for 1 to 4 units, because otherwise they will not be able to sell the loans to Fannie Mae or Freddie Mac. Okay? And for the DSCR loans, this doesn't work the same way, because they don't have like a Fannie Mae or Freddie Mac, like big government agencies purchasing those mortgages. They have like REITs, RETI, purchasing in the secondary market, but those kind of private secondary market actors, they don't have like those stringent rules to purchase the mortgages. So they can work with 1 to X number of units for residential, but usually for DSCR I would recommend 1 to maybe 8 or 12 units, because if you are purchasing, for example, a multifamily complex, I think it will be a better rate for the commercial loan. So for the property types, you can get also retail, industrial, or other kind of small commercial properties. The timeline for the due diligence to resolve the loan, usually for the home loan it will be 1 month or more, and for the DSCR loan at least 15 days. So it will be a little bit faster, the DSCR loan, usually because they are private lenders and they have not as hard processes like the banks. And the interest rate for the home loan will be around 2% lower than the DSCR loan. That's a pro for the home loan because you know they have a secondary market with the big Fannie Mae and Freddie Mac, and they offer more loans, so they can scale better than the DSCR loan. And you should pay for a home loan at this time maybe like a 5%, and on the DSCR loan maybe you will be paying like a 7%. Okay, so let's do this example on the board. So let's say we are going to purchase a fourplex, 4 units rental property, and we will apply for a loan with the DSCR of 1.2, and it is interest only. Some of DSCR loans are interest only. I would say most of them are interest only. So that's another pro of DSCR loans, because your monthly payment will be less and you can get more money because the monthly payment will be less. So the acquisition cost of this fourplex will be $500,000, and the rental income will be around 12 months. So we will have an annual income of about $62,000 a year. And the property taxes, at least here in Texas, will be around $8,000. The insurance cost will be around $6,000. The interest in this particular DSCR loan will be around 7%, the interest rate, which comes to $28,000 a year. And the down payment will be, since the lender is only giving us 80% of the $500K, we have to put $100K for a down payment. So let's going to calculate if the bank or the lender will lend us based on the DSCR of our income we are getting from the property. It has to be above 1.2%. So let's do this math. So the loan payment will be, to calculate the loan payment, we have to do by the rate divided by 12. So we have for the loan $400K because we have the $5K the cost of the property less the down payment. We have $400K times the loan rate, which is 7%. The loan payment will be $400K, which is the cost of the property, $500,000 less the down payment. We have $400K times the loan rate, which is 7%. We end up with $28,000 interest for the loan a year. If we divide it by 12 months, we end up with this amount, a little bit less, more than $2,000. So let's now calculate the DSCR of our loan. So we have the rent less the operating expenses. Okay, so divided by the loan payment. For the rent, we have an annual income of $62,400, and we subtract the operating expenses, which will be the property taxes, $8,000, and the insurance cost, which will be $6,000. As I already told you, for the operating, the lender usually only takes these two costs. He doesn't run a due diligence. He only takes usually the property taxes and the insurance cost. So we end up with $62,000 less $8,000 for the property taxes and less $6,000 for the insurance, divided by the amount we are paying for the loan, which is this amount because it's annual, this calculation. That will be $48,400 divided by $28,000. That will be a DSCR rate of 1.7%, which will be higher than the 1.2% that the lender is asking us. We always have to be above this 1.2% of the rate. So for this loan, we pass and we get the loan because we are 1.7% and the lender is asking for 1.2%. And we end up with a in money of around $20,000 because we are making $48,000 and they're asking for $28,000. So we end up for a little bit more of $20,000. As you may see in this video, I explained the DSCR loans. This is a perfect loan for first-time commercial investors because you don't have to rely on your W-2 or your other rental income, and you don't have to run like a due diligence for a commercial property like a B property that you have to rent it out for at least 1 year. So this is in the middle of both. So this is perfect for first-time commercial investors. I also made a PDF with curated lenders that make these DSCR loans, and you can download it in the description. It is the link, you can download it. And also, if you like this video, please give it a thumbs up and subscribe if you like it to receive more videos like this with more strategies for first-time commercial real estate investors. And I hope you like this video and see you on the next. Thank you. Bye.